Hello everyone. If you are new to the channel, welcome. Otherwise, welcome back. In this video, we are going to cover one of the most basic aspects of finance, the share. I will try and go over various aspects relating to this topic. It will not be a complete guide, but by the end of the video, you hopefully will have a more rounded idea of what they are and how they operate. So let's get into it. What is a share? In essence, a share is a single portion of equity for a particular company. By owning one or more of these shares, it will make you a shareholder for that company. This in turn carries certain rights. These will be touched on later. The term share, equity, stock, instrument or security are all used interchangeably by the general public, but within financial institutions they have a somewhat defined meaning. To recap, a share, a single portion of ownership. A stock or instrument, the collective name for the total amount of issued shares for a company. Equity, the portion of ownership of an instrument or collective term for instruments which result in ownership. A security, any tradable financial asset. So why do companies issue shares? Well, to answer this, we need to touch on some points on how companies operate and some more general trading terms. Before a company is taken public, i.e. trading is available to the general public, it must be registered within a particular country with its registering agent. In the UK, this is Companies House. Companies House will maintain the register of companies and incorporate all companies within the UK. Other countries will have their own registering agents with varying rules and restrictions. Once registered, the company is its own legal entity. However, it still must have an owner. This can be a single person or a collection of people. These individuals will be issued at least one share each. These shares will carry with them a face value, also known as the par value, nominal value, or the original value. This should be the share's minimum price, to which no new shares can be issued below by the company, and is set in the company charter. This is how much liability each shareholder has to the company. This is usually a very low amount of the native currency. Historically, in unregulated markets, this was of greater importance. As this is the lowest price a share could be initially sold at, it ensured someone buying them was not getting a worse price than another investor. In modern, regulated markets, this is not so much of a concern, and many countries do not require companies to provide a face value. This should not be confused with the market price, and is not linked to how much the company is actually worth. At this point, the company is now set up as a private company. Now that we know what a share is and how they are created, let's talk about why a company would want to issue more shares. There can be several different reasons for issuing more shares. Some of the most common ones are raising capital. When a company wants to expand its business, it has a few options. One of these can be take out a loan from a bank. This, however, means the company will have to pay back the loan on a regular basis. Another is to sell a portion of its own equity. By selling equity, it allows individuals to purchase shares within the company, thus raising capital for the company to use, and which the company doesn't have to pay back immediately. If the company decides to sell equity, this can be done privately or publicly. Purchasing shares of a non-listed company can be difficult and requires the use of brokers who specialize in this type of transaction. Selling publicly generally involves listing them on an exchange. This is called an IPO, or initial public offering. This makes the company a public company. We will touch on this again in a moment. Another reason is to improve liquidity of their existing shares. When an instrument is listed on an exchange, it may evolve into having poor liquidity, i.e., the number of shares available for buying or selling is low. Companies may perform a stock split, which will increase the number of shares by a certain ratio. In a 2-for-1 split, for each existing share being held, the shareholder will now have 2 shares. This will also reduce the price of each share by the same ratio. This added volume of shares and subsequent reduced share price allows investors to trade the instrument with a reduced risk. Reverse splits also exist, and this would have the opposite reaction, in reducing the number of shares but increasing the price of each one. And the final one we will mention here is just to sell equity for existing investors. Investors within a company may wish to reduce their exposure in part or completely. As such, they will sell their stake either as a whole or partially for the company via an IPO. This is a technique that venture capitalists will use to exit the company they funded, thus recovering the initial investment and usually a large profit. Now we know what shares are, how they are created, and why companies would make more. Let's talk about where they are actually traded. As I have mentioned, when a company decides to undergo an IPO, they will choose an investment bank to work with to help them to underwrite their listing on an exchange. The underwriter will help the company prepare for its listing by helping them decide how much they should list, what type of securities to list, how many, and along with the price of each. They will also drum up interest in the new instrument from fellow investors to ensure that uptake of the new instrument is successful at launch. Between the company and the underwriter, they will also have to decide which exchange to list on. Some examples of these exchanges are the London Stock Exchange, the New York Stock Exchange, the Hong Kong Stock Exchange, the Nasdaq. Each will have criteria that companies must meet to be able to list or float on their trading platform. This can be market capital requirements, number of shares being offered, etc. Market capital is the number of shares listed, multiplied by the price. Exchanges have several markets which have different listing requirements, and smaller companies may find that they are limited to a less glamorous exchange. This will also affect the type of investor they will attract, as each market caters to different types of investor. Individuals who wish to trade these instruments can do so via a company called a broker. These brokers have memberships with the exchange either directly or via another broker, and their computer systems are connected to each other's trading platform. An individual submits their orders to their broker, who in turn will forward these orders to the exchange. The exchange will maintain what is known as the order book for each instrument. This is a list of orders of varying sizes and prices from various brokers and clients. Here they will cross or match with other orders of the opposing side at the same price. Depending on the depth of the opposing side, an order may fully execute or only partially. The depth is the total amount of shares available at that price. Illiquid stocks may have trouble filling fully if there is no depth on the opposing side and the order size is greater than currently available. The exchange will handle the clearing of these orders. This is ensuring each party get the shares or money from the subsequent trade. Exchanges, along with handling market trading, will also handle reporting from over-the-counter or OTC trades, where people have traded off the exchange privately but still have to report this trade back to the exchange. In the previous example, if the broker was to fill the client's order from their own supply of shares, or via another broker's supply. This trade would be considered an OTC trade and reported back to the exchange. Historically, share certificates would be issued and exchanged by both parties upon the event of a sale as proof of ownership. In modern times, share ownership is electronically tracked and certificates are rare. These, however, can be still requested from certain brokers at an additional cost. Companies themselves may buy back shares they have listed using the company's profits and reduce the number of available shares on the market. This would have the natural effect of increasing share price. Moving on to the next step. Once you have bought some shares, what are the benefits of share ownership? The individual rights for each company's shares will be noted in the company's statement of capital. The class of share should be noted, as this is also important to the shareholder, as they can have different rights to other issuers' shares by the company. Share ownership generally confer the holder the right to receive notice, attend, speak at all general shareholders' meetings. They also allow the owner voting rights on company matters raised by the directors of that company. Many listed stocks are classed as ordinary shares. Generally, each ordinary share will hold the right of one vote. Obviously, owning more shares of the same class means more votes. As each share is a portion of the company, this entitles the owner to a portion of the company's profits. This is known as a dividend, and one of the main reasons for share ownership. Some other share classes include preferred shares. These are shares who obtain a dividend. Before all other class of share, this is generally a fixed value per share. Redeemable shares. These are shares issued on terms the company can buy them back at a future date. Alphabet shares. These are shares for the same company that might have different voting rights or dividend quotas. An example of this are Facebook shares, where investors who own Class A shares maintain a single vote per share, while Class B shares hold 10 votes per share, allowing the owner of this class to have a significantly smaller holding while maintaining voting majority. That is all for this video. Please re-watch if anything is unclear. Comment if you want more information, and I will make further videos. If you want more information on why I'm making these videos, check this video here. As always, look after yourself and your money, and I will see you in the next video.